So in this video we're going to talk about how properties are accounted for in a limited company. You know, it's something we overlook as property investors, but you need to know it. You need to know what you need to give to your accountant at the year end, and it's going to help you understand why they ask for the information. So when it comes to property and your limited company accounts, how is it accounted for? This is a question we get asked a lot, and today I'm going to give you some very technical accounting talk on how properties are measured and how they're treated when it comes to preparing your accounts. So the first thing to mention here is that when it comes to preparing limited company accounts, there's a couple of different ways that it can actually be recorded. So there are a number of different accounting frameworks, and broadly these are principles and guidelines on how you should account for different things. So in the UK, as it stands, the two that you're probably going to be most aware of, or that apply to you and your limited company, are FRS 105, and what this is, it's basically the micro accounting regime, and its aim is to simplify as much as possible, so you can't account for uplifting property values. You don't have to worry about a lot of the more complex accounting treatments. That would apply to a larger company, which would use one of the alternative accounting frameworks. The second one you'll be looking to do is section FRS 102, and it's 1A. And this is basically it's a small companies exemption as well, which removes a lot more of the filing requirements and a lot more of the kind of complicated accounting notes and disclosures that would usually be applicable. So that's probably one of those two accounting frameworks are what your accounts are being prepared under. So if you go for the simple one, basically what will happen is your property will be recorded at cost, so how much you paid for them, plus your stamp duty, your legal fees, any capital improvement expenditure, and that's it. It gets recorded as that, and then what we try to do as well is we depreciate the value of the building, so we try and separate the building and the land element out and record that as depreciation over its expected life, say 50 years or so. That's the simplest way of doing it, and it doesn't involve any professional valuations, anything like that. It's nice and simple. But the downside to that is that the more depreciation you've got going through your accounts, the lower your retained earnings. So if it's a significant amount, it might actually result in less dividends being payable. Of course, that's something you'll need to balance up as a director. The second approach, section FRS or 102 or 1A. This is what most companies go for, and especially as you grow and exceed the thresholds for FRS 102, this is what you'll be put on by your accountant. And here you need to measure the value of the property. So at first, as soon as you purchase the property, you're going to record it at cost, and then each and every year thereafter you'll measure its fair value. So what this means is what the property is worth less the cost to sell. So if it's gone up in value, you record this in the accounts. So if you purchased it for 100, it's now worth 200, you would have £100,000 worth of fair value gains going through your profit and loss, which would basically result in that property value on your balance sheet being higher than the cost, its current market value now. This is great because it allows your balance sheet to show a true and fair view. So when it comes to looking at your assets and your liabilities, you can clearly see what they are and how much they are. So it's great for that side of it, but it does come with its complications. You need to recognise deferred tax, which is a complication, and you also might need professional valuations to support these annual market valuations, which can result in additional costs. So there's a brief run through of how the two different accounting frameworks impact how properties are accounted for when it comes to preparing your accounts. Another thing to mention on the fair value side of it as well, when it comes to those revaluations, so just because you've got a £100,000 gain potentially on that property uplift, you're going to take away any deferred tax liability off of that, but also the amount that is available. So those funds, because they're unrealised gains, you can't use them to pay dividends. So you need to make sure that your accountant is separating this out, because if you look at your profit and loss and you see you've had a £200,000 gain in there or something like that, and you think you can pay this out as dividends, you can't. These are unrealised gains. You cannot legally pay them as dividends. If you do, they'll be deemed as illegal dividends and you'll need to repay them. Thank you very much for watching today's video. I hope you found it very useful. If you did, give it a thumbs up. Drop a comment in below. Do you want more videos like this explaining the accounting side of it? And make sure you do check out some of my awesome videos on the rest of my channel. Bye for now, guys.